Welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm so glad that you are here with me. This is the show dedicated to helping you not just survive retirement, but to rock retirement. And you know the way that you do that, don't you? It's by focusing on the right things. That can be hard. And taking lots of intentional actions to create a great life. And so that's what we're going to talk about each week. Now, this month in the Retirement Answer Man Show, or on the show, we are in a hard at work mode. And so let's go talk about that with the most amazing co-worker ever, Nicole Rockstar Mills. All right, it is the day before Nicole's favorite day of the year, which is...
Yes!
What are we dressing up as tomorrow, Nicole?
The kids want to do Guardians of the Galaxy this year. So when we're recording this, it's still far enough out that might change. But as of now, the plan is to do Guardians of the Galaxy.
Okay. And I was specifically instructed by Nicole not to mention that I dress up as a whoopee cushion or use a fart machine, because that is, I guess, not appropriate. So I will not mention fart machine or whoopee cushion on the show. And this is our last...
So, you know what's funny about the fart machine, though? It goes off
Everything,
when the battery's dying.
Everything?
Well, everything, but it was in a drawer in our house, and it just started going off on its own when the battery started dying.
Because I sent her one last year. Okay. But this is the last week of Hard at Work in October, because myself and the team are hard at work on planning out all of 2020 shows, which, man, I'm really excited. And 2, working on the so-okay retirement course for the Rock Retirement Club. Is that better?
Oh, well described. I like that.
Better than the best the world has ever seen that I did last week. And we're at a little bit membership drive for the Rock Retirement Club because our prices go up literally in 2 days for enrollment into the RRC. This is your last chance to lock in our current rates for your life. You just go to rockretirementclub.com. Now, this episode that we're going to play today, Nicole, actually is one that's sort of important to me that nobody ever really talked about. And this is about some of the dangers of index or passive investments. They're great when markets go up, but there's some quirkiness about them. There's some structural things about them that people don't know. And I don't mean just common investors, but this trend in passive investing has been amazing. It's a great thing, especially from a cost perspective. But there's always 2 sides to a coin, and I think there's not enough discussion about this other side. So let's go listen to that. Well, way back in 2007, you remember 2007, don't you? That was right before the great drop in the S&P 500. It went down from October 2007 to March 9th, my son's birthday, 2009. It went down over 50%. Well, right before all that happened, Warren Buffett, the legendary investor, placed a wager with Ted Cetus, a hedge fund manager. They bet $500,000. And the bet was, Warren said that the S&P 500 would outperform hedge funds over a 10-year period. So he placed that bet right before this big drop in the index that he was betting on. Well, guess what? That bet concludes the end of this year, December 31st. So according to Buffett's explanation in a letter, if you had invested $1 million in the funds chosen by Ted Cetus, they would have grown by $220,000. And in the same period, Buffett's low-fee investment would have earned $854,000, making him a clear winner. He goes on to say in his letter that investors have lost, over that 10-year period, over $100 billion on high-fee Wall Street money managers. And it plays out pretty well. A study published by the S&P Dow Jones Indices says in 2016, 90% of active stock managers failed to beat their indexes over the previous year, the previous 5 years, and the previous 10 years. So the question is, should we all just go passive into the passive type investments and save all that investment fee money? Well, maybe, and we'll dive into that a little bit more in the hot topic segment. But before we do that, we need to have that all important disclaimer. Hey, this is time for that all important disclaimer, and I make fun of this, but it's pretty serious. Now, I don't know you. I don't know anything about you, so I can't give you advice. And you don't know me. You know I don't know much about you, so you do not want to take advice from me. So the best course of action is to think of this as helpful hints and education. And when you do make a decision, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, let's get to the hot topic segment and see, should we all just go passive? So in the news today, it's something to consider whether we should just dedicate all of our investment assets to passive index-based investing. It seems to be the trend. In fact, passive investing, passive-based investing, seems to be taking over the investment management world, not so slowly, but surely. So if we look at the percentage that are invested passively, meaning in some type of vehicle that mimics an index in the U.S. stock market only. Back in 2000, only about 12% of U.S. stock market investment assets were in passive index-based mutual funds, ETFs, what have you. Fast forward 5 years, and it goes from 12% to 17.5%. It's a good increase. Good steady increase of people adopting passive investments more and more. Let's go forward another 5 years. It goes from 17.5% of U.S. stock market assets that's invested in passive type investments to just under 25%. All right. We're starting to see some growth in the passive investing. Now let's go forward to last year, 2016. 42% of U.S. stock market assets are invested passively. That is quite a jump. Now, it still dwarfs active investing, but what's not really caught in that is that a lot of active investors, and we've talked about that on the show before, a lot of active investors really are passive indexers. So that number is probably a lot higher on U.S. stock market assets that are in some way tethered to the S&P 500 or some other very popular index. So the question becomes, if we join this passive crowd 100%, does passive make the market more efficient or less efficient? Now, I think the Warren Buffetts of the world and the John Bogles of the world would say it's more efficient in that you are paying a lot less in fees, which is totally true. But think of it from this perspective. Might it make it less efficient? Because if so much of every dollar is going into passive or passive-like investments that are all focused on almost the same indices, they're buying without respect to any fundamentals. So does that make things more efficient? I'm not sure. Now, a second thing you might want to consider is if all of this money, this massive flow is going to all of the same companies, and we understand how these indices are constructed. We've talked about this before. Like if the S&P 500, although there are 500 companies in the index, the largest companies have the biggest influence over the performance of the index, meaning that as companies get bigger, they have more and more sway over the performance of the index. In some instances, almost all of the annual performance of, say, the S&P 500 can be accounted for 10, 20, 30 companies out of those 500. If that's the case, then as more and more money pile in, it becomes more focused on hot sectors due to how these indexes are constructed. More and more money is flowing to fewer and fewer stocks as they get bigger. Now, I'm not arguing against passive. I just want to point out that how we're defining passive right now is by very specific indices like the S&P 500 or the Russell 2000. And all of this trend towards passive seems to be going into one funnel of what passive is. Legendary investor Jim Rogers was quoted in MarketWatch a week or two ago talking about this exact question about ETFs, which is a big vehicle for index-based investing. Now, he warns that a bear market is coming, and he says it will be horrendous, the worst. It's the level of debt across global economies that will be to blame. Now, will a bear market come? Yeah, a bear market is going to come because it's part of cycles. It's a forest fire that brings things back to rationality every now and then. So I'm not worried about trying to time the bear market. But one thing he points out I thought was interesting and something that we need to consider, something you should consider, and that is when we have a bear market, and this is Jim Rogers in the article, a lot of people are going to find out, oh my God, I own an ETF and they collapsed. It's down more than anything else. Now, why would he say that? I think in part why he says that is because everybody owns passive type investments. Everybody, I'm being dramatic there, that are tied to the same indices. So if the most popular indice that is used in index-based investing for the U.S. stocks is, say, the S&P 500, well, if the vast majority of money is going to investments tied to the S&P 500, and then we enter a bear market of such, and everybody turns around and goes the other direction, and they sell, which historically we show that in bad markets, investors sell, they run for the hills. And that's one thing. If they're running for the hills, but there's 30 different exits that all are, own slightly different things. But if they're all running for the hills and they're all going out the same door, that can just exaggerate the drop in prices for companies tied to that particular index. So why is this so important? Why is this so important to talk about? Because over time, markets can be efficient and you hold on and you'll be fine. Now, that may be true for a 20-year-old that's contributing assets or a 30 or 40-year-old that's contributing assets and still has a 10 to 20 to 30-year time frame. But why it's so important to talk about in this show, I think, is that retirement isn't like accumulation investing. Our investing time frames are very compressed. If you're 60 years old, sure, you're probably going to live to 30 years. Well, not probably, but there's a 50-50 chance right now statistically. But you're going to be drawing money out, not adding money. And when you're drawing money out with compressed time frames, having big drops, especially early in retirement, could literally destroy all your plans. That's why I think this is a big issue for us. Now, I think part of the solution might be redefining a little bit what is passive investing, what really makes it quote unquote better. I would argue that a lot of it has to do, I would say the majority has to do with the fact that it's a lot cheaper. I think the S&P 500 ETF I looked at, you could buy and it had an expense ratio of 0.04%. The index that tracks the Barclays EFA index is about 0.33%. Add on to that trading costs, which are things that are factored in that you don't really see. And with ETFs or index-based investing, typically those are really low because they don't trade a lot. Now, compare that to U.S. active stock funds, which are about 80 basis points or 0.8%. Plus, a lot of them trade a lot more, so there's more trading costs embedded that you don't see. You can see one very glaring reason why quote-unquote passive-based investing outperforms active investing almost all the time. They are a heck of a lot cheaper. And I agree with that. I think investment expenses are very important when we're looking at performance. But right now, the passive versus active debate, I don't even know how to say it because there are passive investments, passive-like investments that are not tied to a very select group of indices, such as the S&P 500 or the Russell 2000. They own many companies that are outside of those indices, so they're much more diversified than this very small subset that has been chosen as the standard bearers of passive investing. So I think one answer might be, control fees and find investments that have very low fees, give you very broad exposure to the markets, but they aren't all focused on one entry or one exit door of the name of one particular index like the S&P 500. I think that can go a long way to accomplishing the same goal and mitigating some of the risks from the result that almost all active investing are going all into the same indexes, owning the exact same things. So when everybody does run for the exit, you might be able to have a side door that might help you not get hurt so bad so you can protect your retirement. All right, now let me put my soapbox away and let's go to the practical planning segment. We're going to bring Nicole back on and answer some more of your listener questions. Hey, welcome to the practical planning segment today. So we're going to have more listener questions today. And to do that, I want to invite back on my awesome sidekick, Nicole. Nicole, how you doing?
I'm great.
All right. So who do we have up first?
Let's start with an audio question because I know that you like those.
I love audio questions.
Yeah, of course. So here's Tyler with his audio question.
Hey, Roger, this is Tyler up in McKinney. And just had a question about the beginning of 2018. Most people will receive raises. And in the average 3% range, I just had a question about my wife and I, assuming a straight 3% raise. With that, I've generally been just applying that towards 401k and bumping up that retirement account. But with the uncertainty of the economy, I know that the economy is on the rise, but, we have this certain uncertain political environment as well as global with like North Korea and stuff. I didn't know, would it be better? And I know there's no promises or guarantees, but just in general, would it be just better to be conservative and maybe just apply that towards like a debt snowball? I'm sure it's not a bad idea. Just didn't know from a retirement standpoint. I know dollar cost averaging is good, but if there was a chance that there could be a economic downturn, would it be better just to do the foresight now and just apply it towards debt?
Hey, Tyler, first off, thanks for the audio question because I love audio questions. And it's great to hear your voice. And you bring up some really good points that I find we're always asking ourselves about what we do with our money, especially when we're dealing with the markets. So I sort of think of what you asked in two different elements. First off, what do you do when you get a raise? And then the second part is this uncertain political environment in North Korea and all that other stuff. So let's deal with that in two different segments. So one is, what do you do when you get a raise? Now, Nicole, you're probably never going to have this problem, but if you ever got a raise, go ahead. She's smiling.
Last week he fired me. This week, no raise. Womp womp.
Womp womp. So when you get a raise, that's extra money coming into your household. And it's okay. How do you allocate that to support your family? Because that's what we're all ultimately trying to do, right? Is live as well as we can today and try to be good stewards of what we're able to produce as income. So when we think about that, it's important to think about it from a net worth perspective. And okay, I have this extra money coming in. And in your case, you're talking about 3% raise. There's really 5 things you can do with money. I can't think of anything other than these 5 things. And Nicole, you tell me if you can think of another one. Number 1 is you can spend it on lifestyle. Right? You can spend it on your kids or on paying bills. In my instance, I'm trying not to spend it on an iPhone X, which I've heard is at 10. Exactly. I was talking to Chip, who works at Apple, and he actually pointed out to me, Roger, it's not an iPhone X, it's an iPhone 10. And you know why there isn't a 9, Nicole?
I don't. Why?
Because I said, well, what about the 9? He says, well, it's the 10th anniversary of the iPhone. So that's why they skipped it and went to 10.
Interesting.
Yeah. Or in my verbiage, it's the X. I said, Chip, I'm sticking with X. Anyway.
It sounds cooler.
Yeah, I like the X. So number 1 is you can take that raise and spend it on lifestyle. That's the first thing you can do. The second thing you can do, it's a cool thing, is give it away. You can give it to your family. You can give it to charities. You can tithe. That's part of what you can do with any monies that you have coming in. The third thing you can do is one you mentioned, Tyler, is debt snowball. You can actually pay down debt with this extra money coming in. And that's going to really shore up your balance sheet. So that's the third thing. And I like these in this order, by the way. I like when you're thinking about what to do with excess money, whether it's too much savings or a raise or unexpected money you come in, is think about it. Okay, let's look at lifestyle. Let's look at giving. Let's look at debt. The fourth one is let's look at savings. So when I think of savings, Nicole, I think of emergency fund, cash for some upcoming expense, like tuition next year. I got Spencer and Emma, I'm going to have to deal with a fall tuition. So I got to start saving some money in anticipation of that. And then the last thing is investing. And part of that sounds like what you've been doing is your 401k. Keep increasing your investing in your 401k. So when you're dealing with this, go ahead, Nicole, you're going to ask something?
Well, so I'm curious, when you say you like them in that order, why look at, lifestyle before saving?
Well, it depends on where you're at, because most of us are trying to live as well as we can today. Now, that doesn't mean spend it first, but some people are living paycheck to paycheck. So you want to make sure you're spending on the need part of it. That's a good point, though, because it doesn't just mean more stuff, right?
Right.
But that's the checklist I typically go through. So that's what I would suggest that you do, Tyler, is think of things in that order from a balance sheet perspective. Because if you're already saving, say, 20% of your income into your 401k, you may be a little lopsided. If you have debt, you mentioned debt snowball. So if you're saving 20% of your 401k and you have all this debt out there, you may be a little bit lopsided. So maybe it does make sense to rebalance that. But you have to do that from looking at your net worth statement so you can identify where some of those imbalances might be. Does that make sense? So the second thing he brings up, Nicole, is this whole idea of uncertain economic and political times. That's pretty scary. I would argue, when haven't we had those?
I agree with you.
Yeah, we've done some shows on that, in that it's always unstable. It always seems scary. My business partner, Phil, was talking to me last week. We were talking about North Korea, and he can remember worries about North Korea back in the early 70s. And what are we going to do about North Korea? And I'm listening to one of my favorite podcasts right now called Hardcore History, which are these 6-hour-long podcasts that just are totally captivating. And right now he's talking about the rise of the nuclear age right after World War II. And you start to realize, man, even back then, they were thinking that, it was uncertain political times, uncharted territories, what's going to happen. So my argument there, or my thought I want to leave you with there, Tyler, is it's always that way. I think just last week, we entered the second longest bull market in the history of the U.S. stock exchange, just surpassing one in the 50s. Well, I remember coming out of 08 into 09, and March 9th was the bottom of the market, which happens to be my son's birthday. And you thought the world was going to implode. And many people never got back in or got balanced again in how they were investing because they always thought the next shoe was going to drop. So I would say, don't worry too much about market turmoils. Focus on what you can control and make sure that you have a reason why you're investing and you're balanced in some way. Now, obviously, I deal with retirement, and investing for retirement is very different than investing for accumulation. You sound pretty young, Tyler. And if that's the case and you're in accumulation, then you almost want to hope for bad markets because you're going to be buying for many years to come. So hopefully that gives you some perspective to answer your question.
Roger, our next question is from Ed, who is looking for a retirement specialist to help him with his retirement planning. And he is actually interviewing someone who is in his town and has a weekly talk show. He's got a CFS and a CAS, and he's now the president of his own firm in Omaha, Nebraska. So he looked up this advisor on FINRA.org, and he saw some things that concerned him. And he writes that the advisor has 26 years of experience at 14 firms. Most are 1 to 2 years, and the longest was 5 years. He's had one dispute, and from what I can tell, it was resolved. Are these huge red flags? Is it unusual to work at that many firms? And full disclosure, Roger, he does include a note here at the bottom that says, do you have clients in Nebraska? So,
and I actually replied to Ed directly on this. And the first thing I said was that, by the way, at the end sort of taints everything else I say, right? Because it sort of sounds self-serving. So at the risk of sounding self-serving, let's answer this question. So it's a really good question, by the way. I think you're smart for looking for a specialist because, one, when you're entering retirement, that's a very different animal than accumulating assets. And that's one reason why I try to specialize in it, because there are just so many layers of things you got to deal with. I think that's a smart thing. I think the second smart thing that you did is you looked up the person that you were interviewing on FINRA.org, which there's a broker check feature where you can look at the entire work history and any complaints and just see a sense of what their career looks like. And in this case, it sounds like this guy has had a lot of different firms that he's worked at, a lot of stints of 1 to 2 years. which honestly, it is sort of troublesome. Personally, I don't know how you build a career when you're constantly starting at a different firm every other year. How do you build a knowledge base to gain traction as a professional or in your craft? So that is a little bit worrisome. The other thing from looking at it that worries me is that all of them were insurance companies, or the majority of them, let me say, were insurance companies. Nothing against insurance companies, but I know the culture of insurance companies, and generally they are very good sales organizations and primarily commission-based, and generally think of the world from an insurance-first mindset. Now, I'm not saying that about this guy. I'm just making some observations from what you've given me. So you looked them up on FINRA and you're looking for a specialist. I think those are great ideas, Ed. One thing that concerns me is something that you said, I don't think you read it, Nicole, was that the first meeting was introductory. And the next meeting that you haven't had yet, he's going to provide a x-ray of your portfolio along with a high-level retirement plan, even though you haven't signed anything yet. The reason that's a little worrisome to me, and tell me if this makes sense, Nicole, is that means that you've disclosed a lot about yourself. If he's going to do a high-level retirement plan, that means he's gotten, what you're looking for, what your goals are, what your concerns are. And he's also...
So he can tell you what you want to hear, basically.
Yeah. Not even necessarily in a nefarious way. I like that word. Just that he knows a lot about you. So any message that comes from, sort of like you saying, by the way, do you work with an advisor, sort of may skew how I say things, right? It's just human nature. And he has your portfolio. So now it has become a game of this is where you're at. Here's a game of inches of how we might be able to make it better and maybe save you some money, which sort of puts you in the sales process. We have a resource, and I think it's in the Learning Center.
Yes, it's in the Learning Center, but I can include it in Six Shot Saturday for everybody.
Yeah, perfect. About how to interview a financial advisor. And the approach I like a lot better, Ed, and it may seem counterintuitive, but in that first introductory meeting, you ask almost all the questions before they know a lot about you. Now you got to disclose some normal things, your age, roughly your net worth, things like that. On the form, like if someone interacts with me on our website, we have a small form that people fill out to give us some basics. But the reason I like you to ask all the questions and let them do all the talking in the first meeting and make sure you ask the right questions, and this form, I think, gives the right questions, is you're going to learn about who they are before they know anything about you, which is a little bit more pure. It's not skewed. I mean, if you got gray hair, I guess they know that you're close to retirement, but you're going to ask pointed questions about their process, about their certifications, how hard were they and how relevant are they, things like that. And there's a bunch of questions in that resource that we'll share out. But I like that approach better because it puts you in control and it keeps you out of a sales cycle, which is generally how financial advice industry has grown up. Now, one thing, since you're looking at a retirement expert and not someone that's just focused on accumulation, how do you grade somebody who is going to help you on that journey to retirement, which is where you're at, right, Ed? Now, so if we think of the money you spend on an advisor, I'm just going to think this out loud. You want to have a return on that investment, right? You're spending money on fees. Our clients pay us fees, right, Nicole? They do pay us.
They do.
Okay, we didn't forget that. And you want to have a return on that investment. So when you hire someone for retirement, is it about outperforming the market? Is that really where your return is going to come from on picking the right investment and zigging and zagging in the right areas, sort of like Tyler wanted in the question before? I think that, you can have some return on investment in really good investment management and being prudent, but there are areas in retirement, especially, where the return on investment is really hard to measure. So that doesn't make it easy for you to evaluate. And it makes it hard for the advisor to justify their existence. But I think this is probably where the biggest levers are to add value. So let's think of what some of those might be. So I'll use some examples that I can think of with clients. Now, one client, prior to 2008, this is a doctor, we had great markets back then, and he was doing lots of good things and saving. And in one of our little conversations, it was about what confidence level we had to achieve his goals. And the confidence level was on the higher end of where we needed to be. And that gave him some currency to spend in terms of some decisions to make to bring it back down to the sweet spot of us being confident that he is on track. And so at the time, I think the options for him were where we could improve his goals because he was looking at getting out of his full-time work earlier. That was one option, which would, skew the confidence level a little bit lower, which is what we wanted. Another one is you could save a little less money because we didn't need to keep funding because we had these, had some better than expected returns relative to what we had factored in. I think the last one we looked at is lowering the risk level of his portfolio because he didn't need to take as much risk to try to get growth because we found ourselves in this great situation. So walking through the discussion, he chose 2 of them. He decided not to change the goals, and we lowered his savings level by a bit, and we lowered the risk level in his portfolio because those were 2 things he valued over changing his goals. So, and it just so happened that literally the next year we started to go through the 08, 09 market horrors, and it really helped him because all of a sudden we had a lot less impact because we had lowered risk right beforehand. It wasn't because we thought the markets were going to go down. We just identified that he had those options and helped him prioritize which ones to take. So now let's think of that. How do you put a return on investment for that type of counsel? You really can't, right? You can't put a number to it. Another example, and this is another 08 example. This was with a lady who was in her late 60s, already retired, had a pretty nice lifestyle, still does. And when we started going through 08 and really started to have market downturns, her confidence level was getting on the lower end of comfort. So we had to make some adjustments. And the adjustments we ended up making were we did some portfolio things, but she slowed down some of her wants and her wishes. She traveled domestically rather than internationally. She slowed down her spending along with a few other things that we did that helped ride out and preserve her assets during times of stress. And she was open to that. And that's the whole idea of being flexible. I don't know how you put an ROI on that. How do you factor in the return on investment or giving confidence to save a bit less or calm in the storm? But those are the kinds of things you want to try to identify when you're interviewing advisors. So hopefully that helps you, Ed, and others out there. And we'll give you a link to how to interview advisors. So hopefully that wasn't too self-serving. Nicole, what do we got next?
So you did a good job. But you could be our 19th state, Nebraska.
Okay. That was totally self-serving. Okay.
That was totally self-serving.
Next question.
Our next question is a little different. It's from Keith, and he has a question about paying off mortgages. So Keith has rental properties in addition to a mortgage on his home, and all of those mortgages are at rates below 4.5%. So he's wondering if the money that he would normally use to put towards his retirement savings is something that he should put towards all these mortgages so that when he retires, he's debt-free.
That's a great question.
He feels like he'd have more freedom if he did that. So what are your thoughts?
That's a great question, and it's a normal thing to question. Should I keep funding my 401k or retirement account, or should I pay off debt? Now, Keith doesn't tell us how old he is, and we don't know his entire balance sheet. So as always, I'm talking in generalities, but you said you about have $900,000 in retirement accounts. Some of that decision is going to depend on the totality of the balance sheet, right? If you're way lopsided in retirement accounts and you're 55 or even 45, you want to balance that out by having after-tax savings. I don't know what your income is. You have about $370,000 in mortgages, it looks like. It's similar to the Tyler question before, is you have to have the net worth statement and go through the checklist to decide where the home for the dollar should be. And that has to be done in the context of, okay, how old you are, what income sources you have, what you value more. And it sounds like you're valuing freedom. I will say, I do like entering retirement or the pre-retirement phase with as little debt as possible. Debt, you look at a balance sheet and it looms out there on you, right? But what it also does is it also gives you less flexibility because you have to make those payments, right? So your fixed overhead is fixed, which puts more demand on generating income from other sources, which gives you less flexibility or less freedom, to use your word, Keith. And again, this is that ROI question. The old argument is, well, if I can make more than 4.5% in interest that you're paying on your mortgages, well, then it makes sense to keep the debt. I don't like that kind of math. It's easy and it's simple, but there are a lot of other types of returns, such as financial flexibility by not having those payments. So at some point, I need to figure out how to quantify that. But I agree with you, but it has to be done in the totality of it, Keith, in terms of how much you start applying. Based on what you've given me, I think it makes sense to start to tackle some of that debt because that's going to give you more freedom and more peace of mind when you enter a phase where you may not be earning so much.
Our next question is completely different on required minimum distributions. This one is from Timothy, And he says that he's withdrawing a monthly amount from his TSP account that's not adequate to meet his RMD. And they said that they would automatically send him a supplemental payment to round it up to his RMD number. But that payment is not going to actually come until sometime in the first quarter of the following year. So he wants to know if that's still going to satisfy his IRS requirements.
And then it looks like he also has an IRA, and he wants to know whether he needs to compute that for his IRA as well, or whether his broker will do it. Now, this is interesting. Now, I'm going to beg a little bit of ignorance here. So RMD, first off, that's required minimum distribution. So that's something that has to happen once you're 70 and a half from any tax deferred accounts. And it's based off of a life expectancy, and it increases a little bit every year. And you got to do it. And technically you have to do it by the end of that year. So if you have a $10,000 RMD, required minimum distribution, say in 2017, it has to be done in 2017. And if it's not done in 2017, the penalty is huge. It's like 50% of what you should have taken out. So let's stick with that $10,000 example for a second, Timothy, and say you didn't take any of that out and you took it out in January to March. Well, if you did that, the IRS penalty would be $5,000. So it's a huge penalty. Yeah. Now, the only caveat to that is the year that you turn 70 and a half, they give you until April of the next year. So maybe you're just turning 70 and a half, Timothy, and that's why they said that January to March timeframe. So if that's the case, then I would at least have a conversation with the administrator of the TSP to confirm that. Now, the second issue on your IRA, I would not rely on in this case, I guess it's Charles Schwab, to calculate that for you. They may be able to help you calculate it, but it's your responsibility to make sure it's taken out. They may send you some notices, but I would suggest that you do that yourself.
Thanks for that question, Timothy. That's all the questions that we have for today. Keep them coming, guys. We love to get your questions, especially audio questions. So make Roger really happy.
I love audio questions.
RogerWhitney.com. Ask a question.
Well, that is just about it for another show. Nicole, how can people get a hold of us if they want to leave a question or talk to us about the retirement journey?
Please go to RogerWhitney.com and you can click on Ask a Question or Work with Roger. And we'd love to talk to you more about your retirement journey.
Awesome. We're going to have more questions next week, I think. So until then, I am Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit RogerWhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.